And a continued stealth tightening. That's what our next guest says he's most concerned about in the markets this year. Joining us now to elaborate, Noah Blackstein. He's senior portfolio manager at Dynamic Funds. Do you think conditions right now are tight, too tight, Noah?
Well, real rates are tight. We've obviously had a pickup here. We'll get a PCE that's probably a little on the hot side because of some of the numbers here in January. But for the most part, I think, the larger concern is that inflation really fell toward the end of the year. Rates are still 5.25. So you're looking at very high historically real rates and continued runoff of the balance sheet with QT and the draining and eventually the draining of reserves with that. So, I think that there's real numbers and then there's sort of hypotheticals. And I think the damage one can do by leaving rates way too high for way too long significantly outweighs the damage by slight cuts later on in the year. I think, though, that we're in a new narrative. I think that, from November of 21 until probably last summer, that it was all about raising interest rates regardless of the economy. That at least is now over. I think if there is pronounced weakness, perhaps it's much more likely that the Fed's going to act on rate cuts. I think there's been a lot of nervousness over the near term on some of the inflation numbers. So we'll have to see how overall they play out. But you've got strange weather in January, and you've got some seasonals and residuals, and so we really need more than just one month's data to play out. But my larger concern is that they decide not to do anything and inflation keeps falling, and that would be a problem for the economy for sure.
I just think it's a lot of cross currents, though, and it all in an election year, because it seems like the work the Fed did so far, you can't really point to anything in the economy that looks like it's really, I don't know, maybe you can, but, unemployment is still low. GDP is still strong. So at this point, it looks like we've been able to weather the interest rate increases, the normalization of interest rates. And there doesn't seem to be any reason at this point why the Fed would cut other than it's an election year.
Well, I think, I disagree. I think if inflation keeps falling, if we get down to like 2.5, you're talking about real rates at nearly 300 basis points. That's pretty high. I think you can target real rates, real rates are even at 150 or something like that. So the outlook for inflation. So you don't believe
January. You don't believe it, either one. You don't believe the CPI or the PPI.
No,
whatever.
If we're running 3.25, and they're kind of leaving rates where they are, that's fine. I think importantly, the economy seems to have weathered this, the greatest tightening cycle in 70 years. So we've certainly weathered that, and positioning is such that we have over $8 trillion sitting in money market funds today. So, if we look at it overall, there's clearly the economy's weathered it. There's money out there and things like that. So if they're not lowering interest rates because the economy is strong, that's not a bad thing for equity investors. In fact, if they're drastically slashing rates for equity investors, it probably means we're in serious trouble in the economy. That's not great for equity investors. I mean, I'm not going to talk about bond investors because they talk too much anyway. But for equity investors, I think a strong economy and good earnings is important with falling inflation. So, I don't think that's a bad scenario for the stock market overall and for equity investors in particular.